The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Very good morning to you and welcome to Squawk Box Europe. I'm Juliana Tattlebaum with Carolyn Roth, and these are your headlines this Monday morning. Investors gear up for the big headline risk event with a Christmas cut baked into the Federal Reserve's decision this week, setting the scene for other central banks' final policy meetings this year.
Rising exports to Europe helped China's trade surplus top $1 billion for the first time, with outbound shipments up nearly 6% on the year as French President Emmanuel Macron threatens the country with tariffs. UBS could be set for a boost as the Swiss government reportedly prepares to loosen part of a banking regulation package that would otherwise force the lender to add more than $24 billion in capital.
A very warm welcome to the program. Let's get right to a preview of the biggest risk event for the week. What's set to be the biggest risk event anyway, and that's the Federal Reserve. A Christmas cut appears to be on the table for the Fed this week, with the central bank set to kick off its two-day meeting tomorrow. Traders are currently pricing in an almost 90% chance of a 25 basis point cut, according to the CME's Fed Watch tool. This despite internal divisions, with 5 of the 12 voting members having expressed skepticism or opposition towards a move lower.
Good morning to you, Juliana. You pointed out this could be one of the biggest risk events of the week. I would argue, given what the CME is currently pricing in, there's no risk attached to any of this, given that it's fully priced in. It's very hard for the FOMC to back out of this. But of course, you're right. This is the one event that everyone's watching this week. I want to show you what U.S. markets did in Friday's session. And we saw some pretty healthy gains there. The Dow up by 0.2%, the S&P 500 up by a similar percentage amount, and the NASDAQ comp eking out a gain of 0.3%. For the week, Juliana, we also saw pretty modest gains. The second positive week in a row for these U.S. markets. The S&P up by 0.3%, the NASDAQ rising to the tune of 1% for the course of the week. Of course, we got the delayed September data in the form of the core PCE number that was more or less in line with expectations and didn't ruffle too many feathers. Also, let's switch over to the Asian trading session, where we are seeing a little bit of a mixed picture at this point in time. The Hang Seng is down by 1%. The Shanghai Comp, though, is up by 0.5%. We got the Chinese trade data that blew past expectations. We'll get into that in a short while. And the Nikkei 2 to 5 up by 0.2%. Seesawing a little bit this week. A lot of focus, of course, of what the BOJ is going to be doing next, whether it's going to be hiking rates very soon. When it comes to European futures, we are opening up for trade in about 50 minutes time. And this is the picture, a little negative. The CAC 40 seen down by 0.3%, the DAX seen off by 0.1%, the FTSE seen off by 0.2%. Again, keep in mind, European markets were pretty much flat on Friday. For the week, though, we saw some gains yet again to the tune of 0.3%. When it comes to U.S. futures, this is what you're looking at. We're still a few hours away. When it comes to the start of the trading session across the Atlantic, the S&P 500 seen up by 0.3%, the Dow Jones seen flat, the NASDAQ seen up by just a smidgen. How's the dollar looking this morning, Juliana?
Let's take a look at the dollar crosses and the lead up to this Fed decision. Right now, a euro dollar trading firmly. Not a huge amount of action in sterling this morning. We're also, of course, keeping an eye on the Japanese yen as well, given the moves we've seen in Japanese bond markets in the last couple of weeks, with yields moving sharply higher. In terms of bond markets, let's get you a look at treasuries right now. We are looking at yields marginally higher across the curve. Stateside, the 10-year trading around 4.14%, the 30-year out at the long end 4.797%, and at the short end of the curve, you got the 2-year note trading around just over 3.5%. David Zahn joins us now, head of European fixed income at Franklin Templeton. David, great to have you with us. Nice to see you.
Good to see you.
Let's kick off with the Fed. It seems to clearly be the big risk event for markets this week, even though the decision itself for December seems like a foregone conclusion. What are you thinking about in the lead up to this decision?
Well, I think that, as you said, they're probably going to cut this week. And I think the real focus is on how much are they going to cut for the rest of the cycle. And our view is they probably have 2 more cuts left, and then they're going to be done, which isn't as much as the market's expecting. But then also what we really have to look at is who's going to be the next Fed chair. How is he going to behave? And I think that's probably what market's going to start to focus on now.
And in terms of markets focusing on that, what do you think is priced in when you look at the Treasury curve in terms of longer term rates in the U.S. if we are looking at a next Fed chair who leans more dovishly than Fed Chair Powell?
Yeah, we think that overall the long end of the curve is probably a bit overvalued at the moment. But I think that's kind of a global phenomenon because we see that yield curves are steepening everywhere. The U.S. should be no different. And if we have somebody who's more aggressive at cutting rates, then you probably expect that to occur. But you can also see that in Japan, where the yield curve is steepened quite significantly, and also in Europe.
David, this is Carolyn jumping in. Great to speak to you this morning. The story, as you just pointed out, globally in 2025, and I assume that's set to continue in 2026, is the steepening of the yield curve. How much further does that have to go? And I'm also quite curious about your call specifically when it comes to the UK.
Yeah, I think that overall the yield curves will steepen, and I think it's really down to a couple of fundamental reasons. One is the 10-plus part of the curve. There just aren't as many buyers for it, and we've seen that in the UK with pension reform. There aren't as many buyers there. We've seen it in Europe now with the Dutch pension reform. The big buyer of long-dated debt will just not be there as much. So I think the longer end of the curve will get steeper. There won't be as many buyers, and it'll probably get more volatile, which for active managers is quite good. I think the UK, as you pointed out, is probably one of the more interesting ones at the moment, given what's happened with the budget a couple of weeks ago and the ongoing rumblings within the government. And our view is that rates need to go higher in the UK because there's so much uncertainty as far as fiscal, despite the fact the economy is quite slow. But the inflation is quite sticky. The Bank of England won't be able to cut very much because of that. And so therefore, we do think yields will drift marginally higher.
I just want to draw your attention to the call that you've made, a bit of a contrarian call earlier this year. At 30-year gilts, yield will hit 6%. Again, bit of an outsized call here on the back end in reaction to the budget. We actually saw yields falling somewhat, fewer concerns about debt sustainability. Do you think that will actually come to the forefront again? And why do you think you're right on that call?
I do think it'll come back to the forefront over the next couple of quarters. And it really is because the way that Treasury has done the revenue raising is a lot of it is backloaded. So they're spending a lot in the first 2 or 3 years, and then they're saying, well, in 29 and 30, we'll just raise all this revenue and make sure everything's okay. There's a couple of reasons for concern on that. One is obviously we have to have an election by 29. So usually you don't start really increasing taxes as you go into an election. But also the second part is you may have somebody else in power in 30. And so if that's the case, all of these supposed revenue increases may not come to fruition. And I think that's when people get more concerned on what is the overall scope for rates in the UK.
David, let me take you to Asia, where there's actually been a ton of focus over the last couple of weeks with what's been going on in Japan. Yield spiking. I mean, the 20-year, I think, hitting its highest level since 1999. The 10-year, its highest level since the financial crisis. What do you think of the moves we've seen there and where we go from here?
Well, I think, again, it's one of those, it's driven globally, but also Japan, they're raising rates. We know that they have a rate hiking cycle. We also know that the new prime minister wants to just spend a lot of money to get the economy moving, and that's obviously needs to be financed somehow. And so I think put those two together means that rates are going to continue to rise in Japan. I also think it's really important globally because Japanese investors are one of the ones that go in search of yield globally, but at the moment they get quite good yields at home, so maybe they won't come as much to Europe or the US. And so I think that will also have an impact on more global markets as opposed to just Japan.
Yeah, exactly. If suddenly these domestic investors can be getting much better yield in Japan, are we going to see repatriation of some of the money that's been in treasury markets in particular?
I'm not sure necessarily immediate repatriation. I think what it will be is people will stop sending money outside because they'll say, well, if I buy a treasury and I hedge the currency risk, I don't really get much return. Whereas in Japan, I can get our 2% on my 10-year. So I think that will be their focus.
David, let's talk one of the biggest problem childs of 2025, and that was France, obviously. When we take a look at the OAT bond yields, obviously, they've been widening somewhat. 74, 75 basis points is where we currently are at. What should be the right spread here? And what should be priced in, what should not be priced in? Should investors actually be pricing in a forthcoming collapse of the government yet again?
Well, unfortunately, I think the French government will collapse again, so that's not really a new thing at the moment, unfortunately. I think that our view is that good value is probably around 95 to 100 over Germany. France is still a good credit. It doesn't have any problems. Just the volatility of the government is an issue, and the inability to pass a budget. And we think that this budget, again, will have problems passing, and will probably have a collapse of the government. And I think France in this kind of purgatory until 2027 when we have presidential elections. But I don't think it means that they're a really bad credit. I just think that you should probably get more yield for the risk you're taking.
So if the budget is actually pushed through, and this should really ideally happen by the end of the year, will we see a rally in OATs?
From these levels, I would find that unlikely. At 75, I think that there's more risks that are priced in going forward as far as continued political uncertainty in France. And a lot of these measures will again be in the out years when there'll be a new government. And so you keep saying we're going to raise revenue further and further out, but if it's a different government in, they can completely change the entire equation.
David, talk to us about where and how you want to be positioned in the fixed income space going into 2026. Do you see any value in government bonds? We talked extensively about that. What about investment grade credit, which a lot of people, including yourself, probably say is perfectly valued or priced at this point?
Yeah, I think investment grade is the over the rich sector. I think from that perspective, we've actually been reducing the amount we have investment grade. The fundamentals for investment grade in Europe are really good. I mean, we have growth is going to pick up next year, inflation is going to come down, the ECB is on hold or maybe hiking towards the end of next year. But it's basically priced to perfection. And so I think from that perspective, you want to start moving out into more liquid things like governments. And I think that actually will allow you to deploy capital when you get that volatility. And we expect to see a volatility event sometime in the next 6 to 12 months.
All right, David, always great to get your perspective. David Zahn, head of European fixed income at Franklin Templeton. And let's get back to one of our top stories this morning. Chinese exports in November massively beat market expectations, although volumes to the U.S., as expected, were down despite the recent easing of trade tensions between the world's biggest economies. Total outbound shipments jumped 5.9% last month, a substantial rebound following October's surprise contraction. The reduction in U.S. trade was offset by rising shipments to the rest of the world, including to the EU. Now, we've got a lot coming up on the show. Still, President Trump says a Netflix Warner Brothers tie-up could face a problem. Plus, Jamie Dimon calls for change in Europe, warning against fragmentation. And we'll get a check on the AI outlook with the CEO of DeepL. That conversation is coming up at 8:30 London time. Don't go away.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's Miss Jo Malone, CBE.
I started that first business of skincare. That's when I knew that I was in charge of my own life. And that's when the entrepreneur really, although I didn't know what the word entrepreneur meant, that's when the entrepreneur really took hold.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
Got a lot of terrific voices speaking in the Middle East this week, including this one. You want to look for the pricking of a bubble. That's Bridgewater founder Ray Dalio telling CNBC amid skyrocketing AI valuations. Dan asked Dalio what he sees as the biggest risk to the momentum in the AI trade.
You're seeing cracks in venture capital, private equity, real estate. You're seeing that interest rates on locked-in debt are now not going to exist. In other words, debt is now maturing, and that means that it has to be rolled forward. And that'll be rolled forward at higher interest rates. So that's going to create a cash flow for a number of entities in those areas. They are also the owners of money that's going in there. I don't think we're going to have a tightening of monetary policy immediately. And so that'll be neutral. And then I think the real interesting question is a wealth tax question, because the wealthy are getting much more wealthier, but at the same time as that wealth is not taxed. And there's a lot more talk about that at the state level or at the federal level, less so. These are the signs, the early signs of needing, perhaps, to sell wealth to deal with some of those expenses. We also have a very concentrated market, right, around AI, around a limited number of shares. And we also, with these wealth gaps, we have a lot of the political problems. As we go into the 2026 elections, it's likely that the Republicans can lose the House and so on. You will see a lot more conflict in different ways. And also that we have the higher interest rates. So the future, if I was to say the next year or two in the future, is going to be more precarious.
Ray, if you were running Bridgewater today, how exposed would you be to some of these AI mega cap names?
Well, you have to bet on that. I would bet also more on the usage of it. In other words, there's the hyperscalers and so on. But the greatest impact is going to come from the users of it. So those who have the platforms for enabling, or those who actually use it to change their cost and their effectiveness, will be the real beneficiaries. They're not expensive like that. But I also know that I have to have diversification. Diversification is very much important. And we're right now in this situation where so much is concentrated on so few. And so that is a particular problem. So I'd be much more diversified.
And CNBC's inaugural New Energy Finance Forum is underway at Abu Dhabi Finance Week, an exploration of the multi-trillion-dollar shift to a new energy system. The CEO of Circle is actually on stage right now, so let's listen in.
We don't have a lot of footprint. We've got about 1,100 employees with laptops, and we use the cloud for our software, right? So for us, we're like we don't got, we're not making cement and all that stuff. But the blockchain networks, sit in data centers and validate transactions, and those are used. And we actually can estimate basically the consumption of blockchain infrastructure that we
and what do you observe?
that we use. I mean, we can estimate it. I don't have that number in front of you, but I think we're a significant volume of transactions on some of these networks, and each of those do, in fact, some of those networks do publish their own kind of energy footprint as well. So we could, by proxy, get our way there, and it's a great thing. And I'm going to make sure my team.
I think and the growth in the accelerated servers part of data centers is somewhere in the region of like 30% a year. So we're talking enormous numbers here. So sorry, I've given you all homework, and I certainly wasn't trying to pick on Jeremy. I'm picking on all of us, including myself. Let's all go and find out how much of our energy is coming from clean tech. Dan, you're going to get it back on track.
Well, to Steve's point, and as an extension of that as well, Jeremy, do you think that the energy intensity of the industry is going to be a barrier for future development?
So there's mythology here, right? The overwhelming majority of activity on blockchain networks is not energy intensive. Bitcoin itself, which is a very small percentage of the transactional activity in this whole industry, is still a proof of work mining based, energy intensive based system. But basically all other networks that, and in fact every network that Circle's infrastructure runs on, use something called proof of stake, where they're dramatically lower energy footprint. And that was a very explicit change that was made where networks saw that they could use people staking value and putting kind of value at risk to provide security models for these decentralized networks. And that model has really taken off. And so the footprint there is absolutely significantly lower, and I would argue lower than even your typical kind of cloud compute type of infrastructure as well. So it isn't for stablecoin networks and sort of broader tokenization and so on. It is not, it is not an impediment, right? It sort of generally behaves like people who are, maybe there's more websites being built on Amazon or Azure or Google Cloud. There's more blockchain apps, similar type of I think, inputs, so to speak, into the infrastructure side.
Jeremy, I think, again, I'm here to ask all the obvious questions as well, but you mentioned about the regulations and the rollback. Is it as you expected it would be under this administration in the United States as well? One reason cited why crypto has come off is that people were actually underwhelmed by the emphasis and the impetus that the administration is putting behind blockchain and crypto as well. Have things panned out this year as you expected? And if not, where do you hope to see greater impetus?
Well, a couple things. I mean, it's been extraordinary. We've seen the first major piece of financial regulation passed in the United States in decades. The Genius Act was an act that really got its footing as a major Democratic initiative, and then the job got done on a bipartisan basis between Republicans and Democrats. A very bipartisan bill. A supermajority in the Senate, a huge majority in the House, something that leading Democrats and Republicans wanted. It changes the fundamental banking regulatory regime to accommodate this new type of electronic money, these new digital dollars. It is about dollar competitiveness, economic competitiveness, national security, and that's a huge win. And that obviously for us as the leading regulated stablecoin network in the world is critical. And it's led to, as I mentioned earlier, all of these companies coming into this space. So it has surpassed my expectations on that. And then there's other regulatory work that's happening, which by all measures appears on track to become passed into law, likely in the first quarter of next year. Again, very bipartisan, not just a Trump administration issue, a bipartisan issue, and will cement the United States potentially as the leading jurisdiction for digital asset markets. That's a very big deal. And then the regulators themselves have been, effectively making it clear to banks, to securities firms, to asset managers, to technology companies, you can use this technology, just do it with good risk management. And so that's allowing more and more major firms to get in, and that's driving activity as well. So all of that is good. And so I think we're in the best position we've ever been in, and not just in the United States, but all around the world. Every major government is racing to put in place sound policy in this space because the technology upgrades that are happening here are happening so quickly.
Jeremy, the old trope is stablecoin.
Very bullish comments here coming from the CEO of Circle, who's of course speaking to Steve and Dan in Abu Dhabi. And we'll have much more from CNBC's new Energy Finance Forum at Abu Dhabi Finance Week throughout the morning, including Dan's conversation with the UAE's energy minister. That's coming up later this hour. Juliana.
Carolyn, let's push on and talk about probably the biggest story in the entertainment world that we've had for quite some time. President Trump has warned that Netflix's takeover of Warner Brothers could run into problems as it faces a potential antitrust probe from the Justice Department. Trump was asked about the deal on the red carpet ahead of a Kennedy Center event.
It's got to go through a process, and we'll see what happens. Netflix is a great company. They've done a phenomenal job. Ted is a fantastic man. I have a lot of respect for him, but it's a lot of market share, so we'll have to see what happens.
Trump also said he would be involved in the decision on whether the deal will be approved, flagging concerns that Netflix's market share would go up a lot if a Warner Brothers merger is completed. Well, Carolyn, in terms of the fallout from this announcement, which came at the end of last week, it's hard to find any group that is supportive of the deal other than, of course, Netflix, whether it be politicians in the U.S. on both sides of the aisle, Republicans and Democrats voicing concern about this deal, to Hollywood itself and the industry, concern around the impact this will have on cinemas, on actors, on pay. And then, of course, the consumer angle here. If we're looking at Netflix getting an even larger share of the market here, what does that mean for pricing moving forward? And I'm curious what your thoughts are here. We'll just throw out there in terms of the probabilities that are being floated right now. Polymarket putting a 23% chance of the deal actually going through by the end of 2026. That's down from 60% before President Trump took to the red carpet yesterday with those comments.
Wow, I hadn't seen that number. That's quite surprising, and that attaches obviously a very low probability of that deal actually going through. Look, they have 12 to 18 months. They have a big breakup fee. We'll see. I think some of the commentary from analysts was also quite striking. One that jumped out to me was quite a critical one from Barclays, actually. I'm sure you've seen it. It says, we're surprised that Netflix felt the need to spend more than $80 billion and pay a premium for something that Netflix already disrupted, and it's not clear what problem or what opportunity Netflix is solving for that could not have been achieved organically. And I think it begs a bigger question, Juliana, and you and I, we've seen this over the years. Do massive conglomerates, specifically in the media space, do they actually create value or do they destroy value? Doesn't it all come down to this? But a side question, aren't you excited to be watching more content on Netflix, even more so now? I know you don't have a lot of time on your hands, but that's the ultimate logic, isn't it? To have access to even more content that no one has time for.
It is such a conundrum, more content, but who has the time to watch it? And also at what cost? I mean, already when you pile up all these different streaming services, it's amazing how big the bill becomes. And obviously putting it all in one place, it means a fewer number of subscriptions. But what does it mean for pricing? And that's clearly a concern for consumers out there.